So hello guys and welcome back to my YouTube channel. This is Status, and in today's video we are going to look at support and resistance, which is basically a technical analysis. Now before we get right into that, there are three types of analysis. We have fundamental analysis, we have technical analysis, and we have sentiment analysis. Fundamental analysis, it deals with looking at what the economic news are saying before you open a trade, or maybe you close a trade before the news come out. And then we have sentiment analysis. This is where you look at what other buyers and sellers are doing in the forex market, and you might want to consider their actions, because at times you find that when the buyers are more, the market tends to be bullish, and the vice versa is also true for the suppliers. So let's get now into our video. Technical analysis. What is technical analysis? Technical analysis, simply, it is looking at the historical behavior or movement of the price, and then from that you are able to make informed decisions on where the market is trending, either up in a range or maybe in a down trend. And also you want to know what makes up now technical analysis. So we have charts, then we have indicators. So under charts, there are different types of charts. We have line charts, we have bar charts, and then we have now the candlestick bit of the charts. So when we speak of the line, just from the how the line suggests, you are going to find that in the forex market, any assets you trade there or you want to trade, you find that there is a graph showing the movement of the price or how the prices are behaving. And now in this case, when you speak of a line chart, you find that it is something like this. Without saying so much, we go to the bar charts. The bar charts are on the basis of, we have what we call as low, high, close, and open. Now you might wonder what all these are. Maybe you can just do something small here. When you speak of bars, it is something like this. Now, depending on where the market is trending, either on an uptrend, a downtrend, or a ranging market, you find that when the market is on an uptrend, and in this case, assuming you are using the bar charts, you find that this is how the chart looks like. Something like this. You find that this is where we have the low, this is where the market opened, so open, and then the market closes here, close, and this is the highest level the market went at this level. Now, since we've said it's on an uptrend, you expect that the next candle or the next bar will form above this. So it will open here. This will be the low in this case. Then it closes here. And then this is the highest level the market reaches at this level. Then it keeps on opening and repeating the same. And the vice versa is pretty quite the same when it comes to now a downtrend market. And coming to candlesticks, it is a bit different, only that the candlesticks, they have a body which forms something like a candle. And this candle, thanks to the knowledge a single candlestick can provide, because you find that whenever a candle forms, either it is bullish or the candle that forms is bearish, from this one candle you get so much information on how the market is behaving depending on what time frame you are using. Lastly, under technical analysis, we are going to look at the indicators. Now, indicators, just from the word indicator, so they indicate where the market is headed or where the market will go after some minutes, some hours. And the main work of indicators, you find that they will tell you the momentum of the market when the market is moving in a range, or when the market is trending. For a momentum, maybe I can give an example. There's an indicator called as a stochastic oscillator. Uh, for a range, you find that there is an indicator termed as Bollinger Bands, where the market, when the market is in a range, they are so close. For a trend, there is the relative strength index. And now we move aside from that. So now coming to our main topic of the day, which is support and resistance. Now you want to know what is support and what is resistance when it comes to forex trading. In simple terms, when we speak of support, we are speaking of something that acts in the market like a floor, and the opposite of support is resistance. And you'll find that the resistance acts now as a ceiling. So just to say something small on this, in the forex market, the markets are either trending on the upside or on the downside, or the market is moving in a range. You find that the market is consolidated within one area. Either the market is moving up or the market is moving on the downside. So what you expect to see at the support, let me draw a line like that, something like this. The market keeps on reaching this level and then bounces back or changes direction, as you can see, and the vice versa will be the same for resistance, which now it is on the upside. When the market bounces back after reaching this level, which is now our resistance zone. These zones, it is arguable that what forms the bigger part of support and resistance is the issue to do with demand and supply. And support and resistance works on an assumption that the buyers and the sellers in the market, they are the people who move the prices depending on what class of assets in the forex market you are trading. Could it be the currencies, the stocks, and this applies to all the classes that you wish to trade in the forex market. So we have suppliers, so supply and demand. You find that demand and supply, they go hand in hand. We can't talk of support and resistance without speaking of supply and demand, because we've said that the resistance is kind of the ceiling and the support is the roof in the forex market. So you find that at these zones, the support zone or the resistance zone, the people who are going to move the market, either the market to bounce back from a resistance because of the suppliers in the market, and for the market to bounce back from a downtrend now to an uptrend, it's because of the action of the demand created by the buyers. Again, when the supply and demand zones are hit so many times, that zone becomes weaker and weaker. A case scenario is where a market is trending in a range. You find that this resistance zone, the market has tested this area so many times. So this resistance zone, it becomes weaker and weaker as the number of times the market bounces back when it reaches here continue to increase, and the vice versa is also the same for now the support zone. So you expect as these zones become weaker and weaker, you expect something called as a breakout to occur. Either at this level, the market when it reaches here, it won't bounce back, but it breaks out. Either breaks out and continues to be bearish, or breaks down and retests this zone and then goes all the way down in the market, and the vice versa is for the resistance case. The market now in this case it will break out, goes and becomes very aggressive on the upside direction, or either breaks this zone, retests the same zone, as the market loves doing that, and then from there the market becomes aggressive on the bullish side. Having said that, when a supply zone is broken, it becomes a demand zone, and the vice versa is when a demand zone is broken, it becomes a supply zone. Let me just illustrate for you. So in this market, this was our supply zone. Our supply zone. Whenever the market was approaching this area, the market was bouncing back. But when it reached here, the market, I've said, when a supply zone is hit so many times, it becomes weaker and weaker. So after the market breaks out at this level now becomes from here a demand zone. So all we expect now from here is either the market to retest this zone and then becomes bullish, and later this level will be considered as a potential demand zone when the market tries to reverse and approach this zone. And the vice versa will be the same when we speak now of the demand zone, which is here. The market might hit this demand zone so many times, and at times it can break out here and becomes bearish, and this ceases now to be the demand zone and becomes our support zone. So having said that, the last bit under support and resistance is that history repeats itself. That's an assumption forex traders make when they are trading using support and resistance. Basically, forex trading in any asset class, it's all about the future, how the prices will behave in the future, depending on whether it's long term or short term. But support and resistance, you focus on the past. And how do you know where to draw your support and resistance zone? Now, when it comes to trading, or you want to enter in a given market after using support and resistance. So how to enter enter and exit using support and resistance. uh, you find that you need something called as time frame, and again you need 2 to 3 points or levels the market respected in the past. For this case, this is very key. You need to plot a support, or you want to when you want to plot a resistance in this case, or a support, you have to use 2 to 3 previous levels, or in the past when the market behaved in a particular way, we know that it bounced back when it reached that level. So right now we can assume, like in this case for the support, the market has already made this point, this and this, and now it has made this one as well. So, and we would wish to trade this asset class. Could it be a currency, a crypto, or any other asset class? Now we would want to see when the market is coming back now to this area, how it behaves. So with this, our support zone, after the market reaches here, we would be paying attention on what the type of candlesticks that will form there, or the type of chart pattern that will form there, so that you open a trade. For the time frame, you come to understand that the more you use a bigger time frame, the more your zones become relevant. relevant. So how to enter and exit using support and resistance. First, you need 2 to 3 points that the market respected in the past for you to consider as consider it as a valid support or a resistance case. Let me give a scenario where the market is here, but we've used this and this as our 2 to 3 previous levels the market had retested. So we would want to pay attention or close attention when now the market is coming back here again. Forex trading is about patience. When you come to analyze a market, you use your trend lines, you use your horizontal support and resistance in the market. You would want to wait after you've plotted them. Like in this case, we plotted a support zone using 2 levels in the previous the market had reached and bounced back. Now, after doing this, you pay close attention when the market approaches this level. You will want to see what the type of chart pattern will form here or candlesticks that will form here, either reversal candlesticks or breakout candlesticks, and then from there you enter into the market. Assuming you want to enter buy position at this level, so this is what we expect the market to do at this level. After it reaches here, it will form reversal candlestick patterns or a pattern or just one candlestick that is it's a reversal candlestick. Maybe that is something I can do in my next video on the type of candlesticks we have, bearish and bullish candlesticks. We also have chart patterns which are either continuation or reversal again chart patterns. Now after the market reaches here, it forms specific charts or candlestick patterns that tells you we are bouncing back, so you would want to buy. But if it breaks out, you would want to wait for the market to close, to open a candlestick that is bearish and closes below our support zone. From there, you can enter a position there and sell. There are 2 ways to do that. After the market breaks out, you can wait for the market to retest. And for the beginners, I would advise wait for the market to retest as well. And from there, the market becomes aggressive on either of the direction after the market has broken that zone, whether it's a resistance zone or a supply zone. The market will break out the zone, retest, and then boom, it becomes aggressive, and then you enter your buy or sell position. But since we've considered a support zone, the resistance will be the same. The market hits our ceiling. You see, the resistance is kind of the ceiling. It will bounce back or break out. So that is the bit for entering a trade. Now, when it comes to exiting a trade, considering this case, it is a bullish market. So the price in this asset class, whether a currency, it is appreciating in value. So the buyers are more than the sellers. So how do you know when to exit a trade? We've already looked at how you enter trade. You either wait for the price to reach a given zone, either a support or a resistance. It forms given candlesticks or charts at that zone, either bounces back or breaks out, and then you wait for what I've said, a retest, and then you open a position. Now, when it comes to exiting a trade, after now considering this case, the market is bullish, you would want to buy from the lowest level. The same case for selling, you would want to sell from the highest level. So I'm assuming you are not in the market when the market was at its lowest, and maybe you found the market here. You would want to draw your trend lines at this level where the market pulls back. And in this case, this trend line is our demand zone. So how to exit. In this case, we've said you will want to buy. The market is on a long-term bullish. So after here, the market forms bullish candlesticks or a given chart pattern that has formed and the market is to be bullish, you will want to buy here. Now, the next time you want to pay attention is when the market reaches the next level where your trend line is. When it reaches here, you will want to see, just as you waited here for the candlesticks to form here, the chart patterns to form here. When they form here, they'll tell you whether the market is on a continuing trend or it will reverse. And from here, depending on whether the candlesticks tells you to buy more or sell, if it is for buy, you will want to buy more here. If it is for selling, you will want to exit your buy position here, and then whatever you had made with this number of pips you've covered here, you close that trade. Then you open a sell position here. I hope that isn't hard for you. So the last thing we'll look at is something called as time frame. And time frame in the forex market, the more you use a bigger time frame from a daily, weekly, you tend to have relevant support and resistance zone. Just like using a Google map, the more you zoom out, you're seeing a very bigger picture as compared when you zoomed in, and then you find that you're only seeing a very small part of the market, and you might be losing, but because it's not because you don't have good analysis skills, but because of the time frame or you're using to open your trade. So time frame is very key, and just a tip, if you have a smaller account that is on a live trading, you want to consider to avoid using longer time frame. But if your account is big, then looking for the longer time frame is what will work best for you. Otherwise, the last bit is on the forex market. It's all about the future. You want to know where the price is going after an hour, maybe after today, after this week, after this month. So, and talking of technical analysis and these support and resistance, it is about the past. Consider 2 or 3 levels the market respected. Then you use your tools, the trend lines, the horizontal support and resistance to plot those zones, and then from that you're able to know when you're going to buy or when you're going to exit in the market. That has been all for today, so thanks for watching. In my next video, I'll be looking at candlesticks of the chart patterns, and make sure to subscribe to the channel and leave me a comment in the comment section below. Let me know what you're thinking, maybe what I can do on my next video. See you next time.